This episode is brought to you by Progressive Insurance. Fiscally responsible, financial geniuses, monetary magicians. These are things people say about drivers who switch their car insurance to Progressive and save hundreds. Visit progressive.com to see if you could save. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary, not available in all states or situations.
I am very pleased to bring on two of my favorite financial analysts in the country, Bob and Ryan Payne of Payne Capital Management. Gentlemen, thanks for joining as always. Boy, another tumultuous week with all sorts of signals pointing in every which direction, which is why I need to have you guys on the show to tell me where the economy is going, where is the stock market going, and what is the best strategy for making more money. So, Bob, I always like to talk to you first in terms of you've lived through the ups and downs of the market for decades. How do you assess this market today? Because I get a lot of calls from our listeners who are just nervous about things.
Well, you know what? The stock market always climbs a wall of worry, Steve. And of course,
that's a good way to put it.
It truly does. And, one of the bricks in the wall that was taken off today was Jerome Powell's comments, where he's now open to cutting interest rates because of the job market. Mm-hmm. So that takes a little uncertainty away. Mm-hmm. And actually it was kind of surprising, that he was, so overtly dovish. But that's what happens in a big booming bull market, which we're in now. All the surprises come on the upside. So Ryan, this is
Ryan, do you think, what do you make of Powell's declaration that he's open to interest rate cuts? I've been kind of on the fence on this for the last few months because I always say I'm paid to worry about inflation, and I don't want to see another bout like we had under Biden. But what's your take on it?
Well, my non-economic take is Jerome Powell wimp. Did he just cave to the president, basically, strong arming him into cutting rates. And I think that's part of it here because let's face it, right? We still have another employment report. We still have another inflation report come September.
Right.
And I'm a little skeptical that the employment market's as weak as we saw last month, right? And we're not seeing any layoffs here.
Right.
And we certainly haven't beaten inflation. But to Bob's point, markets do love it. And I think if you're an investor right now and you're sitting in a money market fund, well, guess what? You got to worry that the interest rate keeps going down. So that's a lot of money that's pouring to the stock market. And it's a big, alarm to say, hey, if you're sitting with too much cash right now or money market funds or CDs, you got to make some decisions because interest rates are going lower.
So one of the big issues, Bob, that has affected the stock market and the real economy, obviously, has been tariffs. Free market economists like myself are not big fans of tariffs, but there's a big debate about whether these tariffs are affecting certain industries and whether they're affecting prices of things. How do you tell your clients how to kind of navigate the tariff wars?
Well, one of the things, Steve, that I always say is the market's smarter than everybody. And obviously the global economy has been able to circumvent the tariffs. I mean, let's face it, these tariffs there's a lot of accommodations being made. So, there isn't any blanket tariff. I'm sure these brokers at the ports are able to help, the ultimate consumer negotiate around these tariffs. So, the market's already told you that this is not going to be a big issue. You've seen China rally, you've seen Europe rally, and now you're seeing a big move in the U.S. market.
U.S., yeah. Well, once that it was announced by Powell, Ryan, that he was open. I don't know exactly how to interpret this, but I think he's saying he's open to cuts in September. The market really loved that. But is that just a temporary little burst, or do you think this is is this something that will last in terms of higher prices?
Yeah, I think it's for real because the economy, let's face it, even with rates where they are, is in pretty good shape. If you look at economic growth, it's accelerating, right? It's much better than the first half tracking right now for the second quarter. Like we mentioned before, people have jobs. People aren't getting laid off. If you look at those wages, they are now growing over inflation, and that means people have more money to spend. And it's all about the consumer spending, Steve. I don't need to tell you. So I think overall, this just adds what I would call fuel to a fire that's already burning. So again, like if you've been procrastinating on your finances or trying to figure out what to do, like you can't wait. You got to make decisions here because clearly at this point, we have a relatively strong economy and we just added, some gasoline to that fire. So it's like you can't sit on your hands here.
I'm talking to Bob and Ryan Payne of Payne Capital Management, and it's bebullish.com, right?
Best URL that you can possibly type in.
That's a really easy theme to remember. So, Bob, Ryan brought up the case that this is a time for making some moves. In what direction? I mean, what do people do? I'll tell you what I'm worried about, guys, and I'd like your reaction. I just keep hearing from my friends in Florida and some other states that the real estate market is really capped out, that they're starting to see a real slowdown in purchases of homes. Now, they're talking about at the high end, the $2, $3, $4, $5 million homes. But, we don't want to see a real estate crash. We know what's happened. We remember what happened in 2008 when that happened. And by the way, I'm not saying that we're on the precipice of a crash. I don't think we are. But how concerned are you about the housing market?
Well, first of all, Steve, we have at our firm, we have what are called the Payne principles of wealth. And one of those principles is all markets revert to the mean, which is simply, all markets have a correction. I mean, you look at the price of your home. Everybody listening right now, look at the price of their homes, wherever it is in the country. We've had a huge increase in prices. Right. So, having a little consolidation, a little turn down should be expected. It's like a rubber band. A rubber band can't expand forever; it has to snap back. So I think that's going to be temporary.
But my point would be, I agree with you. But the question, of course, is this a temporary, little setback for housing, or is it the start of a long-term bear market for housing, Ryan?
I think it's more of a temporary correction because you got to remember the big theme here is we have an undersupply of homes, right? After the great financial crisis, which I still have scars on my back, Steve. We remember there was not a lot of building of homes for a whole decade. So if you look at supply right now versus demand, we're still short homes in this country. So yes, we get a price correction here because interest rates have gone up. You have to adjust to close to 7% mortgages, but you're just not going to get a big fallout like we did during the housing crisis because we had an oversupply. We have a completely different issue now. So that should keep, some sort of, let's say, bid under the housing market. But I think a correction here is definitely in order. They've risen so much over the course of the last couple of years, and now interest rates are a lot higher.
So given that kind of uncertainty about the housing situation, that's another reason that people use professional financial advisors like yourselves. And I have to say that, even when I was pretty bearish, you were bullish, and you guys have been more right than I have on the market. So do you continue to have confidence in the market, and what advice do you give it to investors?
The knee-jerk reaction here, Steve, would be to join you and jump in on NVIDIA, right? You know how much money you've made on NVIDIA. It's been a gigantic mover, right?
Right. Yeah.
But I'm telling you right now, there's a golden opportunity when you have interest rates come down. What really benefits are small company stocks. We're seeing the companies in the Russell 2000 up over 3% today. There's also a huge opportunity in international stocks because as our rates come down, our dollar weakens, and you're going to see the emerging markets and the developed markets continue to lead.
Ryan, we got 1 minute left. What would you add to that?
Well, first off, it's too hard to be this good, Steve. No, I appreciate you giving us props for being bullish the whole way through here. But I think what Bob just said, it's a golden age for income. And most of our clients are baby boomers. They're getting close to retirement. They're retired now. And let's face it, if you just buy the tech stocks or the S&P 500, you're getting no cash flow. Meanwhile, if you diversify that money right now, dividend yields are probably some of the most attractive we've ever seen. Valuations are reasonable. And again, you got to lock into some bonds here because the Fed's going to cut interest rates. So to build an income portfolio, you have the best opportunity ever. And baby boomers need income. So this is the time to do it. The stars are aligned.
Bob and Ryan Payne of Payne Capital Management. You can get a hold of them by going to bebullish.com. They've been bullish for a long time, and they've been right for a long time. So I would certainly encourage you to get in touch with them.